Hi, good morning. We're now going to look at how the budget has affected some of the financial planning issues that we face. Looking first at pensions, Graham has already outlined and summarised all the allowances that continue to apply next year. So we're just going to look at some of the opportunities. Now, first of all, the lifetime allowance is now £1 million. There is still an opportunity for you, if it applies, for you to lock into the previous lifetime allowance of £1.25 million using either fixed or individual protection 2016. Now, there's no deadline for you to apply for this, but we would urge you to seek advice as soon as possible before you do anything that could make you ineligible for that protection. More importantly, there is still the opportunity to lock into the lifetime allowance prior to that of up to £1.5 million. That's under Individual Protection 2014. Now, there is a deadline for this, and that's the 5th of April 2017. So if you don't apply for it by then, you will lose that opportunity. Moving on to the money purchase annual allowance. Now, this is dropping from £10,000 down to £4,000. Now, there are two issues here. First of all, if you are thinking of taking any money out of your pensions very soon, but it's not an absolute necessity, then think very carefully about it. Because if you also feel that you may wish to add more money into your pensions in the future and get income tax relief on that, just taking £1 out of your pensions today will mean that you will limit your ability to pay money in the future right from £40,000 a year down to only £4,000, a significant drop. The second issue on this is that if you have already drawn money out of your pensions and you are thinking about putting some more money into pension to get income tax relief again, then you ought to look to do this before the 5th of April because you'll still be able to put up to £10,000 in and get tax relief on that. If you wait until after the 5th of April, that's down again to only £4,000. Moving on to unused relief from previous years on pensions. If you haven't made the full pension contributions for the last 3 years, you have the ability up until the 5th of April to pay up to £170,000 into your pensions and get income tax relief on that money. If you delay until after the 5th of April, then that amount will gradually reduce because the unused reliefs from previous years, where the allowances were much higher, are gradually falling away. So again, look at the opportunity to maximise these allowances whilst they are still there. Now, we know that higher rate income tax relief is still available on pensions. This is very valuable, but we have to ask, how long is this going to last for? I personally don't think it's going to last for that much longer. We may see it disappear in the next budget later in the year. But whilst it lasts, it is extremely valuable. For a typical 40% taxpayer, the value of that on your savings is increasing that value in those savings in retirement by, on average, between 41 and 75%, possibly even up to 112%. It's extremely valuable. So the message here is use it whilst it still lasts. You know, take advantage of the unused reliefs you haven't used in previous years and put money in and get that higher rate relief while you still can. Moving on to ISAs. Now, the government, obviously, they do like to simplify things, so these are now all the ISAs that we have available. I'm sure you'll agree that really makes it simple, doesn't it? Looking at those very, very quickly, these three largely unchanged in the budget. The only real change is for junior ISAs, the annual amount that you're allowed to pay in has increased slightly. Help to buy ISAs, again, largely unchanged, and these still remain very, very attractive if you are eligible. But the new kid on the block is the lifetime ISA. Now, this comes into effect on the 6th of April. It's only available for those of you that are under the age of 40, and you can use it for either house purchase or for retirement after age 60. You can contribute up to £4,000 a year, and the real attraction of this is the bonus that the government offer of 25%, £1,000 for your £4,000 contribution. That bonus for many people is even more attractive than pension contributions, and we do wonder whether this is the first step to a pension ISA, but we'll have to watch that space. The new ISA, or what we refer to as a standard ISA, the annual allowance for this year is £15,240. If you haven't used that allowance, then do so before the 5th of April to shelter your cash or your investments from income and capital gains tax. If you don't use it by the 5th of April, then you will lose it. You can't carry that forward. That allowance is going up to £20,000 on the 6th of April, so that's quite a generous increase. But I would just stress that's for all of your ISAs. You can't put £20,000 into a standard ISA and then do a lifetime ISA or any other ISA. It's a maximum for all of that. And remember, the ISAs, the death benefit on ISAs is now greatly improved for a couple, because the survivor, on first death, the survivor will inherit the full value of their spouse's ISAs, so they keep those monies in that very tax-efficient environment. But we are now moving into quite a dilemma with ISA, because we have more and more ISA millionaires now. These are people that have used all their allowances every year since ISAs and PEPs began. And they have now built up more than £1 million within those funds. And the problem is for their family that they are looking at 40% inheritance tax on those monies. It is possible now to transfer those ISAs into very specialist ISA AIM portfolios, and these would not only retain the income and capital gains tax advantages, but would also become exempt of inheritance tax after only 2 years. These are very specialist investments, so advice is absolutely critical if you are looking at them. Now, we've heard that we can have a dividend income of up to $5,000 a year, which is tax-free. And that applies for this year and for next year. That will be dropping down to only £2,000 in 2018. How does that affect your investments? Well, if you have an investment portfolio that's generating a fairly average yield, income yield of 2.5% per annum, you could invest today £200,000 and that will generate that tax-free income. Any more investment than that, then the income will be taxable, or if the yield is higher, the income will be taxable. That portfolio will drop down to £80,000 in 2018. So it's absolutely essential, as Graham said, to use all the allowances you possibly can, all the ones we're going through today, to maximise the returns on all of your investments. And if you just used the allowances that are available in 2017, all of those allowances, you could invest over £600,000 and pay absolutely no tax on those investments at all if you structure them correctly. But what would you invest that money in? You could invest in cash. The returns are absolutely rubbish in that area at the moment. You could look at this new National Savings Investment Bond, but really it's not a very good rate, and you can only put $3,000 in. It makes no real difference. You really would need to be looking at investment markets, but the problem we face is that investment markets are very unpredictable. We've had 2 big events in the last year. We had Brexit last May, and this was what the youth of the UK thought of that. We then had a US election. That's what the rest of the world thought of that. And that created an awful lot of uncertainty and fear in particular that investment markets would just crash. But we saw the opposite of that, and in fact, investment markets have performed exceptionally well during that period. And it just goes to show that market timing is very easy with the benefit of hindsight, but it's extremely difficult when you're trying to make a decision when you don't know the future. We don't use market timing. We, at Scrutton Bland, we diversify all investment portfolios through models across all the different asset classes. And we use a medium to long-term strategic approach. And this demonstrates why. Don't really worry too much about the detail on the screen, other than every box there represents a different asset class and how it's performed each year over a 10-year period. And if you just plot just one of those asset classes in isolation, you can see how it swings wildly from one extreme to another over the various years. By using a model portfolio, we smooth out those ups and downs. And this is the type of strategy that you would use inside your ISA investment wrappers, your pension wrappers, and your general investment accounts to make sure that you maximise the benefits and the efficiency of that £600,000 that you might invest. But what happens if you've used all your allowances? You've got no more that you can put into pensions or ISAs. What else can you look at? Well, we still implement for clients strategies using VCTs and EISs. Now, these have various different tax allowances and tax breaks, but the most important here is the fact that they provide income tax relief for up to 30% of the amount that you invest. Now, this provides a very viable and extremely attractive alternative or complement to your pensions or your ISAs. And more importantly, these were not touched in the budget. And I think that's a fantastic endorsement from the government for this type of investment. So that brings me to an end of my presentation. I have to put a compliance slide for you all to read and digest.